Hello and welcome to Data Founders, a series of interviews with entrepreneurs and investors, mostly structured around data science startups and issues and challenges associated with these startups. My name is Peter Jagan, and I'm talking to Matthew Ford, who is a partner at Mouro Capital, a $400 million fintech venture capital firm. A pleasure to have you here, Matt.
Yeah, thanks for having me.
Awesome. So today I would say we have a special talk, kind of experimental one maybe. It's our first talk when we focus on a particular vertical. And today it's finance and banking, and we may narrow it down slightly based on the things that Matt is particularly excited about. So today we are talking about data science, how it can be applied in the fintech, what kind of challenges are there. So that's our format for today. And to kick it off, maybe you can tell us a bit more about yourself, Matt. I guess your experience is very unique and relevant to our talks today.
Sure. Yeah, sounds good. So yeah, hi everyone. I'm Matt Ford. I'm a partner at Mouro Capital. I've actually only been with the fund about a year. So prior to that, I was on the entrepreneurial side. So immediately before Mouro, I was chief product officer at Tandem Bank, which is one of the neobanks in the UK. Which I'll probably come on to some of the stuff we learned there, which was hugely exciting from a data science perspective. So there I ran all the product and marketing teams. So that was about identifying the big customer problems that we wanted to solve and working with the product and marketing teams to both build those products out, but also distribute them to market. So I spent a couple of years there. And before that, I was actually founder of a company called Pariti, which, if you're familiar with open banking, we were a very early mover in that space. So I set that business up in 2014. And really the problem that business was trying to address was there's a vast majority of people in the UK who, and globally as well, who really struggle with money. They don't want to think about it. It's the cognitive load of thinking through cash flow and budgeting and all these types of things is really challenging. But actually at the same time, a lot of financial products that exist can be hugely enabling in life, but also actually quite dangerous. Credit cards, if you use them in the wrong way, can be a real challenge. Personal loans can be a great thing, but actually if you don't pay them back effectively, then they can be quite dangerous as well. So Parity was really trying to help people take control of their money, trying to help them navigate the ups and downs of cash flow to understand how much money they had today, but more importantly, what they needed for the future, and to help them pay down their debt. So if they had quite expensive debts, it helped automatically identify ways in which they could pay that off more effectively. So ran that business for 4 years, and really, that was the first foray into data science. I mean, I'll hold my hands up. I am not a data scientist by background at all. I studied history at university, which is a very British thing, I think. I think internationally, everyone thinks you're going to be a teacher if you study history. But yeah, I studied history. I worked in strategy consulting for a number of years after that. And I worked for another small fintech before Parity. But really, Parity, like the big opportunity was that open banking is about basically the bank's data had historically sat in their vertical silos. All your spending data had sat in one bank, all your savings data had sat within the other bank. And open banking basically enables kind of the opening up of that data and for you to use that data more efficiently and effectively for your own purposes. And I really saw a big opportunity to say, okay, once that data is available, so once you can start to use that data and pull it out of those banks, can you start to underwrite more efficiently? So can you start to be able to understand the credit risk of an individual based on their spending behavior, not just on a credit score, which is historically the way that the banks and lenders had assessed people. Also affordability as well. So it's all right whether you're a good credit risk, but can you really afford to make those repayments? What are those cash flow implications? So really saw a big opportunity around data science and the use of open banking data to make people's lives better with money, basically. So yeah, so I founded that business in 2014. We were really early in the space. I think we made so many mistakes of the way that we set up the data science team, set up our data pipelines, all that type of stuff, but learned a huge amount along the way and ended up selling that business to Tandem. So that was how I ended up at Tandem Bank, which was a much bigger, kind of grander setup, if you like, with a much more mature data science set up. So yeah, so my background's entrepreneurial, my background's fintech. You know, I've always wanted to solve big consumer problems with money. And now I've moved on to the venture capital side. So, you know, my interest in the space is still huge, but it's more now helping enable entrepreneurs to fund and to build those businesses to tackle their own problems rather than just building my own business.
That sounds great, and that's an interesting combination. I would suggest to talk a bit about your entrepreneurial journey and then switch to venture capital part and to talk about the ecosystem of fintech and discuss it further. So when you started your company, how did you arrive to that point? What was your maybe journey or any mental model, any framework? Maybe how did you understand that that's what the right time for you to launch it?
Yeah, no, it's a good question. So I briefly mentioned it. I worked for another fintech that was called OnTrees. So I was a very early employee to that business. And OnTrees, I'm not sure if people are familiar with Mint.com. It's probably quite a more well-known example. But OnTrees essentially enabled you to see one view of your finances across all your different accounts and helped you categorize and get a clearer view of where you're spending your money. That was kind of the main thing. And not to oversimplify it, but really it was about, I'm spending too much money on restaurants, you know, I better cut down. So, you know, it was tentative steps into some of the data science problem around bank data, but we weren't a data science team. We were a development team and a product team that was quite reliant, I suppose, on one of our suppliers to do all the correct categorization and to get the accuracy of that categorization correct. I think we learned really quickly that everything was so nascent there, and you know, if the 50% of transactions were getting categorized as like generic categories, the usefulness of that tool is actually relatively small. And I really started to understand the size of the data science problem, because, you know, to take an example, your coffee might be an essential expenditure for you because, you know, I can't start my day if I don't have my coffee. But then for somebody else, it could be frivolous and, you know, something that they can definitely cut back on. So how you start to bring bank data to life, I think it was a really interesting challenge, and how you start to add meaning and insight and enable people to do with it was something else. But OnTrees, it was very successful. We ended up selling it to Money Supermarket, but that was kind of what sparked my interest in, there's got to be more that you can do with this data. I mean, this data, like, nobody's really maximizing the opportunity there. And this was also kind of at the same time as in the UK, and a global problem as well, but there was an increasing rise of payday lenders. So it was a largely unregulated space at that time. And, you know, there's a rise of providers who were offering very, very high cost credit, you know, in the thousands of percent APR for people who had ultimately run short and for whom banks often weren't able to serve very well. So, you know, they might have an overdraft of £50, but that was about it. And, you know, and this was becoming a really common problem. I think in the UK in about 2014, 2.5 million people were using payday lenders. And there was a lot of research coming out at that time about actually the danger of those types of models, because this, although it might seem a small amount of money that people were borrowing at the beginning, it was starting to rack up. So if it was 5,000% APR, you can imagine all of a sudden it's a very, very slippery slope into quite a lot of problems. So those two combined forces, I suppose, of really understanding that the technology was starting to arrive, and, you know, there's a ton of opportunity around bank data to bring it to life and to understand it better. But then actually there was also this massive opportunity to help people who were falling short of money to not fall short of money, but also to if they did need to borrow at much more affordable rates. So it was a bit of a collision, I suppose, of both problem and opportunity at that time. And, you know, and I'd never started a business before. I was completely naive and fresh. And although I worked in this fintech, you know, it wasn't my business. You know, I was an employee, not the founder. So yeah, so I mean, I threw up everything into the air. It seems a bit crazy now looking back, but I quit my job. I just focused on this space for 6 months, and really, I'll come on to it in more detail if it's helpful, but just spent a ton of time really looking for, you know, is this problem as big as I think it is? And more importantly, like, is there a better way of trying to solve it using some of these early hypotheses that I had?
And this process of checking these hypotheses, if you can recall, maybe what were your approaches, hacks, maybe clever tricks to move closer to understanding that
Mm.
these are hypotheses that really work, what did you do?
Yeah, I would do it very differently again, on my next venture. But I think we followed a fairly traditional approach. So we did the classic interviewing, researching as much as possible. And, I think you learn a huge amount just looking people in the eye and asking them quite emotional, difficult questions about money. That, it's a very, very sensitive topic. But I quit my job in, I think it was March 2014. And probably spent about the next 9 months, if I'm really honest, just talking to people, really getting to understand that problem, really kind of understanding whether this was something that, if you provided them with the tooling, they would even want to take it, or if it's something that they just kind of shut the door and pretend isn't happening and won't engage with it. So a lot of it was face-to-face interviews. We didn't do a huge amount of statistically significant, huge surveys or anything like that. I think there's definitely, obviously, a place for that. But again, when you've not got a lot of money, when you're funding it yourself at the time, you're always finding hacks, I suppose, and cheap ways to try and get a referral to a friend or whatever it may be to try and get that insight. So I suppose it was very kind of face-to-face, qualitative research to begin with. But then I suppose the thing that really started to then click, so two of my old colleagues from Ontrees, they'd also both left the business at that time. And we teamed up together to knock together a prototype because, there's only so much research you can do. And this is what I mean by, we probably would do it even different this time round, but there's only so much research that you can do. You just need to get a product in people's hands. You really need to see the data. You really need to see how people are behaving. So we knocked together an incredibly simple prototype, which connected to your bank accounts for a start to understand whether people would even connect their banks if they struggled with money. So if they were in the target segment that we were looking at, would they even trust a company to do that? And then more importantly, could we start to build some simple rules and categorization and approach to basically what I was mentioning before, which was this cash flow forecast, to understand how much money you've got today and what you need for the future. So we did that in our spare time. We begged, borrowed, and not stealed, but we begged and borrowed as much as we could. A company called Yodely was very kind at the time. They offered us to use their service for free for a number of months. Like we just hacked it together. But by the end of the year, we'd actually got something that was working, that we were learning a load of stuff on. We'd got real customers coming through and we got real feedback. And that was the point at which we realized that we'd got something that needed properly developing at that point.
That's amazing, Johnny. I guess we will return to some pieces of it a bit later, but right now I would suggest to where your venture capitalists had. So you mentioned this personal finance space, also open API trend. Could you maybe give us a bit broader picture of what's actually fintech is?
It's a very good question. I mean, fintech could seem quite narrow in some regards, but actually it's an incredibly broad space, and it's probably it's probably worth outlining it in the way that we think about it at Mouro, at least. So we're quite thesis orientated as a fund, and at a very, very high level, we try and split it down into three broad categories. The first being infrastructure, and what I mean by that is, if you have a look at a bank or if you have a look at an insurer, and we invest more broadly than just fintech. We bring insurtech and B2B SaaS in as well. But if you look at the traditional stack, the traditional technology stack of a bank or an insurer, there are so many layers of old archaic technology, inefficiencies across that whole stack. So we see a massive opportunity, and this kind of bread and butter fintech, really. It's fintech 101 of basically improving the efficiency, the accuracy, the ability basically for large incumbents to modernize the technology that they're sitting on. But then the flip side of that is, obviously, if you can improve the stack that you build financial products on, that brings a whole new number of challenges in and lower barriers to entry for challenges as well. So that first bucket, as I say, is the banking and the insurance stack, and I'd include things like KYC, AML, core banking, collections, servicing, a suite of different things within there. And also within that infrastructure category, we're also quite bullish on the infrastructure as a service space. And what I mean by that is, historically, a bank, there's a bank that's fully regulated, and the bank has its technology partners, and they build the full vertical solution. Where increasingly we're seeing this trend, and there's a lot of other VCs investing in this space of what we call embedded finance. which means that basically non-financial brands will start to embed financial services within their product suite. And there's infrastructure that will both enable that from a technology perspective, but also from a licensing and regulation perspective. So that's bucket one, infrastructure broadly. Second bucket is around what we call the challenges. So take any financial product, take a mortgage, take SME lending, take personal lending, you name it. There are attacks from all angles from new challengers who are either serving a different segment that had historically been ignored, or using a new data set or a data approach that means that you can underwrite or offer products to customers that weren't possible before in the past. It could be a new business model. They could be completely rethinking pricing and how that works, or it could just simply be, not simply, but it could be a technology solution that they've got that just means you can rethink that financial product. So that for us means challenges. So we backed Upgrade, for instance, which is a challenger bank out of North America, and similarly Klar down in Mexico. But then in Europe, we've also just backed in the last 6 months Uncapped, which is a revenue-based lender. So they're all types of businesses which are really just rethinking what a financial product is and service, and challenging the incumbents basically. So that's category 2, which is the challenges. The third one is, it's super interesting, but also a little bit further out, which cheesily I call transcending fintech. But this is kind of really thinking about those massive societal shifts that are occurring, be it sustainability and climate, education, mobility. Lots of these things are fundamentally going to shift over the next 10, 20 years. And therefore the role of finance is going to completely change as well. And I often use the example of cars. So historically you would want to buy a car, or you'd finance the car, and then you go and insure the car. An example being that actually the service that we want is to get from A to B, and mobility is going to completely change, be it driverless cars, or services that you can subscribe to cars, all those types of things. So we're really thinking beyond the constraints of a traditional financial product and looking forward for what basically these kind of big societal shifts will mean for the way that we interact and use money.
Great overview. And where do you think across this, which layer maybe sounds like more exciting to you, or maybe where are opportunities for data science startups in your opinion right now, across all 3 layers, or maybe some of these layers are a bit more prone to disruption or to being added and aided by data science? What do you think?
I mean, there's data science opportunities across all of it. I think personally, I'm very interested in the infrastructure side. So I pulled out a few of those earlier of KYC and AML, and there's a ton of opportunity there for building much, much better technology solutions. And data science is often like the key thing in each of those different areas. So I think, I am personally very excited in that space. It's increasingly mature, but there's a lot of new startups all continually rolling into that space as well. From a kind of that category 2 challenger perspective, it's because I was trying to solve that problem before. I mean, underwriting is still, it's still hardly been disrupted. Like the credit bureaus still exist, Experian, Equifax, they are still the predominant ways that lenders source data, and often they're not even building their own like really sophisticated scorecards. They're quite generic scorecards. And that's still a passion space for me, because it means people are getting expensive credit because they can't be priced effectively. It means people are getting rejected for credit because they don't fit within a traditional frame of what a lender is looking for. Or it means that they're struggling with credit and they're misusing credit because either affordability wasn't judged, or the product was too complex, and those types of things. So yeah, I'm personally incredibly interested in both of those spaces and actively looking for startups in those.
And if we focus on these 2 spaces, if we look at them maybe in a bit greater detail, do you think there is any approach or framework maybe to identify problems within these spaces that are really, really well suited to be solved by data science? How a data scientist may think about it, especially those people, those engineers or data scientists who don't have the fintech background, maybe, who are maybe researchers or generalists? What would be its advice?
Yeah, it's a really good question. I suppose there's a couple of things that spring to mind. I mean, the first is is almost kind of manual inefficiency. So, there's so many, either thinking about that banking stack, for instance, there's so many, if you walk into a traditional bank, there's so many manual processes involved there. There's people manually looking at flags that occurred on their transactional screening for potential fraud, and there's people working those cases, taking a list of cases and manually working those cases. That's crazy. It's huge opportunity to both identify the false positives and to be much more efficient in some of that screening up front, but also then if there is a degree of manual intervention, prioritizing the backlog, automating some of those tasks, actually kind of removing some of the manual processes that exist. So, I think there's a ton of data science opportunities wherever there's manual processes, automation opportunities. This spans fintech, but it's completely applicable in other sectors as well. And, to use a real example, there's a company called Juno, for instance, which is in the legal space. So not quite fintech, it's the conveyancing space. And, they basically said, law and conveyancing, so conveyancing being kind of the legal service of when you buy a property, hugely manual. It's about sending a PDF here, it's about reviewing a contract there. So they're just chipping away bit by bit by bit at every single bit of those manual processes and automating it, and using machine learning and AI to both prioritize the backlog of the lawyers, but to also just chip away at those manual processes. And I think that's a really nice example within law and within conveyancing, but that can be applied in so many different sectors and sub verticals of fintech. So I think that would be probably number one, which is, or not number one, but one of the few things out there, which is that manual work. And I suppose kind of another really interesting space, and again, this kind of comes back to the Pariti experience really, which is those areas where there's historically been just either captive data set or a very narrow data set that it's just the way of always doing things. And a credit bureau is a perfect example of that. The credit bureau, the big bureaus exist because they did deals with the banks. They get direct data feeds from the banks, and they have a huge amount of data, clearly, but it's a very known data set that's grown over like the last 15, 20, 30 years. And it just excludes a huge number of customers out there. So I think those areas where you go, okay, well, I don't fit into the traditional bucket of the way that a lender might look at me, or, like there's no data on me. Identity is another area. So where are those areas where the data sets just don't currently work, or it just doesn't fit for you? And emerging markets are fascinating in that regard, because they don't necessarily have established identity providers. They don't have established credit bureaus. And, there's a ton of opportunity there for using alternative data sources. There's been loads of examples of people using social data, for instance, where credit data doesn't exist. So lots of opportunities to kind of look beyond the existing established way of doing things, find new data sources, find new approaches, and really rethink how you can identify, score, assess, personalize all these different things using new data sources. So those would probably be my two that just jump off the top of the head.
I guess both of them resonate really with the data science community and with the things that people do in some other industries. Maybe you can look a bit more at the second one regarding the data sources. Correct me if I'm wrong, there are at least two business models here, right? Somebody may build a tool for a bank to collect this data, for instance, or maybe to produce it synthetically, artificially. Or somebody may decide and to build a credit bureau of 21st century or 22nd century. What do you think about these approaches? Maybe there are pros and cons to both of them. What would be well suited for a data science team, and which one maybe not really? If I'm correct here.
Yeah, no, it's fascinating because it kind of fits into our first two categories a little bit as well, of we see opportunities on both fronts. Because if you can become the infrastructure for many, many, many companies, you can build a hugely valuable company. And obviously, there's great examples out there of Stripe and Twilio and Plaid and those types of companies where they've just become the approach that everybody uses and the infrastructure that everybody uses. So I think there's massive opportunities to do that, to not necessarily build the end product yourself just for your own customers, but to provide the technology and the infrastructure for others to offer that. And I personally really like that space. We invested in a company called Drive Wealth, which I wouldn't really call it a data science company, but it's a brokerage as a service, like brokerage infrastructure company. And they're doing phenomenally well because they're doing some really, really hard stuff. You know, they become the specialists doing the hardest stuff and then enable everyone else to implement them and integrate them. So really big fan of that business model. I mean, it has its pros and cons, because you know, you are reliant on other customers buying and using your solutions. So sometimes when you have a look at the growth of those types of companies, it can take quite a long time because you've got to be an absolute specialist. You've got to do the really hard, difficult things. Otherwise, why wouldn't the client do it themselves? And that often requires a huge amount of build up front, or, you know, a huge amount of kind of richness of features before you can then start to get the scale of customers that sit on top. So you traditionally see, like, I think there's massive outcomes that are possible with those types of businesses, but often it's a slower start, a slower burn. And then once they've really found the 2 or 3 big growth clients that start to use those types of services, that's when those types of businesses really pop. And I suppose to draw it back a little bit to data science, and I suppose to underwriting to some extent, I know the guys at Credit Kudos really well, you know, and they're a really interesting example because they're basically taking that hypothesis, which is bank transaction data is an amazing way of assessing affordability more accurately. And eventually you can start to use a lot of that data to underwrite more efficiently. But they haven't built a lender. What they've done is they built the platform for lenders to integrate. And, you know, and I think businesses like that are really fascinating because then, you know, you can get a lot of the market 90% of the way by using one single provider rather than every single one of them building their own. But I suppose it depends on how much of a competitive advantage as well doing that thing yourself is, because, you know, the example, so Tandem is a really interesting example. So Tandem, we actually built all our data science capability sat in house, and that was because it was absolutely core to the strategy. So similarly, we used open banking data and you know, and we saw the potential of that type of stuff. But actually, more importantly, we didn't want to just do the hygiene 60%, 80%. We actually saw that kind of the data opportunity was the thing that could completely differentiate Tandem. It would mean that they could price so much better than anybody else. It means that we could offer products to more people. And so really saw it as a core competitive advantage. And at that point, you then want to build that in-house. You know, you want to build the right culture, you want to build the right processes, you want to build the right team, you want to then start to use that capability as a differentiator. So I think it depends whether it's hygiene or differentiation. And then as a founder, you know, if I'm setting up one of those businesses, it depends. Is it the data problem that I get most excited about and see the biggest potential for, or do I have a particular end consumer or business use case that I desperately want to solve, and data happens to be the way of doing that. So there's no right or wrong answers, but they're just different problems and both very exciting.
It leads us nicely to the concept known as product founder fit. And there is a kind of a generic, maybe from the beginning of the century, generic view on the ideal team, like hustler, hipster, and hacker. How do you think that is applied or not really to fintech? How do you think an ideal team for a fintech startup does look like?
Yeah, I mean, fintech has its quirks compared to other sectors, and it's kind of what draws me to it, really, which is, you know, when there's regulation involved, things are always 10 times harder than when they're not. But so although it is different to a normal sector, there's definitely similarities to any starting team. And I mean, this is a personal opinion. I as you say, I think the classic model is used, and it's right for so many reasons. But you basically, like, for me, the most important thing is a collection of people who really care and will work incredibly hard to try and solve a specific problem. Because I mean, that's all a startup's about. I mean, there's big organizations, big incumbents, they have all the money they need to innovate. Like, it's not, you know, they could innovate if they wanted to, but they have their barriers and challenges. And I think the big competitive advantage that a startup has is often this narrow focus and this cutting out all the inefficiency, cutting out all the overhead, and just getting a team of people together who are just singularly focused on solving a problem. And there's no politics, there's nothing like that. So irrelevant of the specific roles that you have in the team, I think getting the right people that are bought into solving that problem is the most important thing. And it changes over time, obviously. As you get to 100 people, people are motivated for different reasons, but really it's just finding that trust, finding that team who just really want to solve the problem. I think obviously naturally then there are different roles that people have to play, but you're wearing so many different hats. I mean, when I set up Pariti, there was 3 or 4 of us to begin with, but we're all just doing a bit of everything. I mean, my CTO, he's also at the same time like looking at wireframes and at the same time coming to investor pitches with me. So I think naturally in the early days, you've all got to muck in and you've all got to do a bit of everything, and you've all just got to get completely out of your comfort zone. Our designer at the time was doing research, she was doing design, she was doing product management, she was just doing everything. So I think there's that flexibility of roles. But you of course you need a developer there, of course you do, somebody who can move fast, who wants to ship product and get data and feedback as early as possible. It's great to have a commercial person there, really thinking through pricing and really thinking through how you're going to sell this. We had a designer very early in the team because Pariti was a consumer proposition, and we felt that user experience and user research and all that type of stuff was going to be incredibly important. But then where fintech differs, I think in heavily regulated environments, having people who really know the ins and outs of regulation early on, if you are playing in a regulated space, is critical, because lawyers are hugely expensive. And if you're a startup that it doesn't have any money or has raised a little bit of money, last thing you want to do is spend 50 grand of that or half your money on lawyers. So the ability to understand the regulated environment is probably the biggest difference, I would say. And most of that falls on the founding team's shoulders, and they have to get down in the detail. It can't be something that's outsourced.
And when a startup grows beyond this initial team of maybe 4 or 6 people, how may an integration and interconnection between a data science team and the other teams may look like? You mentioned that you had some learnings through your own company, and I assume you also have some generalizations as an investor, because you see lots of different startups with different teams composition, etc. How do you think an ideal team, if there is any ideal team, will be structured? What somebody can do to integrate data science within the fabric of the company in the best way possible?
Yeah, so I learned a huge amount at Tandem. So towards the end of the time that I was there, they brought in a chief data officer who's actually now the CTO, who phenomenally impressive. If you ever want a guest on the show, I think he'd be the ideal person for it. But he taught me a lot actually about the way, almost kind of the cultural change and the organizational change that you need to properly embed data science into an organization. So again, not being a data scientist myself, and also having seen, I suppose, often great data science problems being solved, but then not effectively in production, or there being like a massive gap between the people building the really smart models and doing really clever stuff, and then there's this massive kind of air gap between them that being in production, and like I just saw it not working very well, both at Pariti, I suppose, to some extent in my own business, but Tandem was really different towards the end. So Noam, who's now the CTO, he came in and from the ground up, data science was kind of embedded into the organization. So he thought in a very, very different way about the way that completely disparate problems that different people within an organization were looking at. And that could be the team looking at fraud, that could be the marketing team who are looking at ideal customer personas and targeting and all that type of stuff. It could be the underwriting team. Like, they all seem quite disparate, different problems that could equally be solved by data science in isolation. But actually, it's about pulling all that together, because a model that the underwriting team might build, there could be some learning that could be applied for the fraud team, that could be applied for the marketing team. So it was that interconnectedness and pulling together and really thinking through that, the whole organization is the data science organization. Everybody is an input. And although you need coordination and you need a structure to pull it all together, there has to be kind of that organizational I suppose, structure to enable that. So yeah, he taught me a huge amount, and again, don't proclaim to be a data scientist, but I've kind of taken a lot of that learnings on now being an investor, because it's very easy to it's kind of a bit of a joke to some extent that you just got to say to a VC, oh yeah, it's AI, machine learning, and all of a sudden they're really excited. And it's a really hard challenge, because without being a specialist, unpicking like how much of that is sales story versus how much of that is reality and differentiation and really credible. So I think I used quite a lot of that learning, those learnings from Tandem in my new job, because you can just see straight away whether an organization is what I call a data science organization, or whether an organization is one that has a data science team. And you can see straight away. And I think that's been hugely helpful, because one scales really well and one doesn't.
And you mentioned this feature of interconnectedness, and are there any other flags maybe that may signal, in your case, to VC, but we're talking about founder here. Let's imagine a person wants to do a self-assessment and to understand if his or her company is really data science driven company, or a company with a data science unit inside. So what kind of flags the person may spot to actually that may make this person to pause and to rethink maybe something?
Yeah, I mean, it's a funny thing about about being a venture capitalist. Unfortunately, there isn't a formula, and I think that's one of the things, that so much of it is intuition, and so much of it it's a people job. So a lot of my time is spent, well, now over Zoom, but obviously before COVID, a lot more face to face. But it's just getting to know that person, getting to understand how they think. I'm never going to understand data science as good as a data scientist ever. And you got to really trust, and you got to really believe in the people that you're backing. And that comes from data science, from pricing, from marketing. You got to believe that they will make the right decisions and do the right things, because you're not in control of that. You just got to find people who will make really great decisions. So it was probably not a satisfying answer, but I find it a lot more intuitive, if I'm completely honest, of just, does this person really believe in doing things differently? And are they setting up their organization in a different way, thinking about things in a different way? Or are they showing the fact that they've got 2 data scientists and, and putting their qualifications on the pitch deck, rather than really thinking through and explaining why that differs from the norm? So probably not an overly satisfying answer, but a lot of it is intuition, and a lot of it is just getting to know the individuals and speaking to them and getting to understand the organization.
I guess you pointed to a very interesting direction, further away from credentialism into a deep understanding of what really people believe in and how they behave, because credentialism is definitely something that we see in data science, like how many papers you published, where did you study, etc. And if and probably, as you're saying, a founder or a VC should look beyond these credentials at the deeper level, right? So absolutely agree here with you. And just to be cautious of your time, probably the last question. We've talked a lot about different things, and could talk more about others, but is there any question or theme or topic maybe that we didn't talk about but you believe deserves to be covered?
Yeah, I suppose we've covered quite a bit of ground. I mean, I suppose one of the interesting areas as well is so drawing again back on the Pariti experience a little bit, as what is the right time? So going back to that, you need to set up the organization right, culturally, kind of from a mentality perspective, from an organizational structure. There's also kind of the pragmatic approach, which is, when you've got like 3 or 4 people in a team and everybody's wearing various hats, you can't spend a ton of time on organizational structure and, like you're in the middle of the fire and you're just trying to find something. So I think a really interesting question for me is that bit at which you start to mature the organization, and at what point do you bring in a data science specialist versus somebody who is good enough in the early days, who may not be a data science specialist at all, but will get you so far. And I kind of use the example a little bit of Pariti, because I think we did exactly the right thing at the beginning, but then we completely underinvested towards the end. So when we had 10,000, 20,000 customers that had connected their bank accounts, not a huge amount of customers, obviously. It's quite a lot of data because you get typically about 6 months of historic data as well. But this is not billions of transactions and years of data to understand cycles and all that type of stuff. So should we have jumped straight to a machine learning approach? Should we have hired all the top talent and built out a data science team and completely changed like the way that we'd structured the organization? At that point, it was probably not the right thing. Like there was so few of us in the team, and we, it sounds cringy now, but we had a very simple rule-based algorithm that, it got us where we needed to get to learn what we needed to do to get to the next stage of business. The mistake we then made was we then probably ran for about 2 more years of refining that approach and refining it, staying in a rule-based world, and not then thinking about ourselves as a data science organization. So we validated some product market fit, we validated the customer problem, we were able to raise some money, and then I think we went too long. So I think a really interesting question is, at what time do you hire the right data scientists into the organization? Who are the right people to lead that? At what point do you then change the structure of your organization? And I think that's probably been my biggest learning, and I don't have the magical answer to it, but there's definitely a gulf between the 200-person startup that's got it right, the 5-person startup that's just trying to survive, and there's that journey in between. And you gotta balance like overinvestment versus underinvestment, getting the right long-term structure versus the short-term structure. And I don't have the answers there, but that's what great founders can do, and that's where the great businesses have been able to navigate that chasm pretty well.
And do you think a part of the answer, or parts of the answer about timing, might be the volumes of data that someone has, and maybe the stage of the company? Like maybe someone can pay a bit less attention to data science before product market fit is here, and then switch gears and to double down on data science. Do you think it's a part of the answer, or not exactly?
Possibly, and because again, I think it depends on the type of organization, because if the organization's one differentiating factor is that they can offer the product to customer segments that previously weren't possible because of the use of data. I mean, if you don't invest early into that, then you're probably going to fall short. If your business model is, we can do this more efficiently with fewer people, an incumbent is really expensive and slow, and by being digital, by being smart, by using data science, we can do things at 1/10 of the cost. And it's more about efficiency. I think that's a slightly different question, because inevitably you're also going to be really inefficient at the beginning, and it's then a journey, and it's probably a slower journey, but it's a journey to then automating and doing more over time. So I think it depends on the business. I really do. But as you say, I mean, if you got no customers and you got no data, it's probably the biggest clue. But then don't leave it too late would be my advice if it is a core differentiator.
Cool. Really, thank you for raising this question about timing. I guess it's one of the cornerstones, really. And it looks like our time for today is probably ending. So thank you for chatting with us today, Matt. Really appreciate that. And I'm sure we will hear a lot of good news about Mouro and startups that you guys are backing.
Great. Well, thank you very much for having me.
Thank you. Thank you.
Cheers,
Speak
bye.
to you again.